Instantaneous fair value gap mitigation, a concept that might sound super complex, but could be the key to revolutionizing your trading strategy. If you've ever wondered how to tap into the hidden mechanics of the market and ride the waves created by institutional traders, then stick around, because in today's video, I'm gonna introduce you to a groundbreaking indicator that leverages instantaneous fair value gap mitigations for insanely profitable trades. Let's get into it. Now, to get started with this strategy, we need to add an indicator known as FVG Instantaneous Mitigation Signals. To do that, you want to go to Tradingview, which is the trading platform that I'm going to be using. If you need to sign up, the link for that is going to be in the video description. Next, you want to load any trading security that you like in any time frame. For me, I'm going to be using the 15-minute time frame of XAU USD. After that, you want to click on Indicators and then type in FVG Instantaneous Mitigation Signals, and it's gonna be this one by LuxAlgo. So what exactly is an instantaneous fair value gap mitigation? Well, let's break it down. A fair value gap occurs when there is a disparity between supply and demand, often caused by a sudden price movement that leaves a gap in the market. These gaps represent areas where not all orders were filled, creating market inefficiencies. Now, mitigation is the process where the price returns to these gaps to quote-unquote fill them, balancing out supply and demand. Now, here's where it gets really exciting. An instantaneous mitigation happens when the price fills this gap almost immediately, specifically 1 bar after its creation. This rapid correction indicates a market highly attuned to imbalances and eager to rectify them. In essence, it signals a potential reversal or continuation in the opposite direction of the original gap's bias. Now, this indicator is made up of the following components. We have this green horizontal level, which represents a bullish FVG instantaneous mitigation signal. At the center of this level, there is this line called the bullish average level, which is basically the average level of this FVG area. We're also going to have a tiny green upward arrow to indicate a candle that mitigated this FVG. And then at the bottom, we have this line, which is a trailing stop loss for long positions. As you can see, it's going to be moving upwards with the price. So if you were to take a long position based on this signal, then this line is the one you're going to be using for your trailing stop loss. Now, on the bearish side, we're going to have the same components, but in reverse. We'll have a red level to signal a bearish FVG instantaneous mitigated signal. There is a bearish average level to represent the midpoint of a bearish FVG area. We'll also see a red downward arrow to show a candle that mitigated a particular FVG. And finally, there is a red ribbon traversing the chart to act as an area for your trailing stop loss. Oh, there is also one more feature hidden in the settings of this indicator, which is TP area and SL area. As you can see, these basically look like the Tradingview long and short position tools, which can help you gauge the progress of your trades. However, I'm not going to be needing this, so I'm going to go back into the settings and disable them. While we're still in the settings, I'm going to increase the FVG width filter from 0 to 0.1. And then on the style tab, you want to disable the bar color. After that, click OK. So how does this indicator actually work? Well, it's going to be printing bearish and bullish instantaneously mitigated fair value gaps. Let's start with a bullish instantaneously mitigated FVG. The way it's going to be identified is like this. First, you identify a bearish fair value gap. A bearish FVG is something like this, where there is a significant downward price movement creating a gap between the candles. You draw the fair value gap starting from the low of the previous candle to the high of the next candle. Now, if the very next candle closes above this level, it's going to turn this from a bearish FVG into a bullish instantaneously mitigated FVG. Essentially, the market quickly corrects the imbalance, indicating a strong bullish sentiment. Conversely, a bearish instantaneously mitigated FVG is going to be the opposite of this. The indicator starts by identifying a bullish FVG, which occurs when there is a sudden upward price movement. You mark from the high of the previous candle to the low of the next candle. If the next candle closes below this level, it turns this from a bullish FVG to a bearish instantaneously mitigated FVG. This suggests that the market swiftly corrected the upward imbalance, signaling potential bearish momentum. The idea behind the working of this indicator is that whenever a bearish FVG is mitigated so quickly, it's a signal that the price wants to go up. Conversely, if a bullish FVG is mitigated on the very next candle after its formation, it's an indication that the price wants to go down. Now, before we explore how we can use this indicator to trade, we need a tool for trend identification. For that, I'm gonna add one of my favorite EMA indicators called 7EMA_5MA, this one by Storewise. After adding it, you want to double-click on it so we can change some settings. On the Inputs tab, you want to change EMA 1 length to 8, EMA 2 to 13, EMA 3 to 21, and EMA 4 to 34. On the Style tab, you want to disable every single moving average option except for the first 4 options. After that, click OK. These 4 EMAs can be used to identify the trend based on their alignment with the price consistently trading above or below them. When the EMAs are aligned like this with the price consistently trading above them, it indicates a bullish trend. Whenever this happens, we're only going to be looking to take long positions. Conversely, if the EMAs are aligned like this with the price trading below them, this indicates a bearish trend, and we're only going to be focusing on taking short positions. Now, let's dive into how we can use this indicator to trade. For a long trade, the conditions are going to be as follows. First, confirm the trend is bullish using the 4 EMAs. They should be aligned in ascending order: 8, 13, 21, and 34. At the same time, the price should be trading above all the EMAs. Number 2, you want to identify a bullish FVG mitigated signal. This will be indicated by the green horizontal level and the upward green arrow. Next, you want to mark the average level or the center line of the FVG area. Wait for the price to come back and retest that center line. A valid retest should come after a gap. So after the signal candle, you need at least one candle that doesn't touch the center line with its wick or doesn't close below it. This means there should be at least one candle that remains entirely above the line. Now, when the price later comes back down and touches the center line with the wick, if the candle that touches it happens to be a red candle, you want to wait for a green or a bullish candle to be printed. No candle should close below the center line. If any of these candles closes below the center line, that entry becomes invalid. Once a green candle is printed without any candle closing below the center line, this is your signal to take a long trade. Now, you want to place your stop loss under the most recent swing low, giving you enough room for price fluctuations. You want to set the take profit at 1.5 times your risk, letting the trade run. And as you can see, this trade was profitable. Now, for a short trade, the rules are inverted. First, you want to confirm that the trend is bearish using the 4 EMAs aligned in descending order with the price trading below them. Number 2, identify a bearish FVG mitigated signal. This is going to be indicated by a red horizontal level with a downward arrow next to it. Next, you want to mark the average level of the FVG area. And then you want to wait for the price to come back and retest the center line after a gap. After the signal candle, ensure there is at least one candle that doesn't touch the center line or close above it. When the price comes back and touches the center line with a wick, if the candle is a green candle, you want to wait for a red candle to be printed. No candle should close above the center line. If any candle closes above the center, this entry would become invalid. Once a red candle is printed, that is going to be our cue to take a short position. We're going to set our stop loss right above the most recent swing high, allowing for some price movements. You want to aim for a take profit at 2 times the risk, letting the trade run, and this was a profitable trade. Ladies and gentlemen, that is the FVG Instantaneous Mitigation Signals Indicator by LuxAlgo. Go ahead and check it out on Tradingview and see how you can incorporate it into your trading arsenal. If you find a way to use it, be sure to let us know in the comment section below. Well, that's been it for this video. I really hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.